If you looked at the market today and only watched the Nasdaq or the chip stocks, it probably looked like the whole market was falling apart. But that is not what the tape was saying. The market was not giving a clean crash signal. It was giving a leadership stress test. That difference matters because beginners lose money when they treat every red day the same. A normal pullback, a sector rotation, and a real market breakdown are three different things. If you can't tell them apart, you either panic sell too early or chase the wrong dip. So in this video, we are going to break down what was actually happening, why the AI and semiconductor trade got hit, why the broader market was not broken yet, and what clues beginners should watch before calling something a crash. First, the headline looked ugly because the weakest area was the most popular area: AI, semiconductors, and mega-cap tech. The Nasdaq was hit harder than the Dow. The semiconductor ETF was hit harder than the S&P 500. Nvidia was under pressure. Tech was the problem area, but here is the key point. The most popular trade is not the whole market. When one crowded group gets sold, that can feel like a market crash because those names dominate the headlines. But a real market crash usually spreads. It does not just hit the expensive leaders. It hits almost everything. It shows up in broad indexes, credit, small caps, equal weight stocks, defensive sectors, and volatility. That's why we don't just ask, is the Nasdaq red? We ask, is the weakness spreading? Today the answer was mixed. The Nasdaq and chip stocks were weak, but equal weight stocks and small caps held up much better. Staples, healthcare, utilities, real estate, and financials were stronger than tech. That's not the normal shape of a broad panic. That's the shape of rotation. Rotation means money is moving out of one area and into another. Panic means money is trying to leave everything at once. This is one of the most important beginner survival rules. A sell-off in the hottest trade is not automatically a market crash. Sometimes it is just the market saying, this group got too crowded, and the AI trade was crowded. That does not mean AI is fake. It does not mean semiconductors are bad businesses. It does not mean the long-term story is dead. It means expectations got high. When expectations get high, the margin for disappointment gets smaller. A stock can fall even if the business is still good. A sector can correct even if the theme is still real. The market does not only price what is happening today, it prices what investors already expected to happen tomorrow. That is why beginners get trapped after huge runs. They see a great story and assume the stock is safe. But after a massive move, the question is not, is the story good? The question is, how much of that good story is already priced in? If everyone already believes the story, then the stock needs more than good news. It needs better than expected news. It needs to keep beating the expectations that are already built into the price. That is why down big today does not automatically mean cheap. If a group was up massively before the sell-off, it may still be expensive after the drop. A 7% decline after a huge run can be a warning, not a bargain. Now, let's separate the three signals. Signal 1, broad index health. The S&P 500 was weak, but it was still near key support areas. A market can pull back without breaking. What matters is whether support fails and whether buyers disappear. For this tape, one area to watch was SPY near 730. If SPY holds that area, the broader market is still absorbing the shock. If SPY loses it and cannot reclaim it. Signal 2, Nasdaq and tech leadership. QQQ was the cleaner stress signal because tech was the problem. A level near 697 mattered because if QQQ lost that zone, the sell-off would look less like a routine leadership shakeout and more like something deeper. Signal 3, semiconductors. Semis were the center of the pressure. The semiconductor ETF had already run extremely hard, so the drop was dramatic. But the important question was whether semis could stabilize above their bigger support zone, or whether they would keep dragging the whole market lower. If semiconductors stabilize, this can stay contained. If semis keep falling and the weakness spreads into equal weight stocks, small caps, credit, and defensive sectors, then the risk changes. That is how you avoid emotional decisions. You do not say, the market is red, so I must do something. You say, what kind of red is this? Is it a leadership correction? Is it a rotation? Is it a liquidity event? Is it broad risk off? Those are different environments. The second clue is defensive behavior. On a real panic day, defensive areas can hold up better, but the key is whether everything starts breaking together. If staples, healthcare, utilities, and financials are holding, while tech sells off, that tells you money is still finding places to hide inside the stock market. That is different from a market where people are dumping stocks across the board. The third clue is volatility. VIX rising toward the high teens or low 20s means risk is increasing, but rising volatility by itself is not the same as a crash. A true fear event usually has volatility accelerating, while breadth deteriorates and credit starts flashing warnings. So, what should a beginner do with this information? First, do not chase the hottest story after a huge run. If AI and chip stocks had already made a massive move, buying the first red day just because they are down can be dangerous. You need a plan. You need levels. You need to know what would prove you wrong. Second, do not panic sell broad exposure just because one crowded sector is breaking. If equal weight stocks, small caps, and defensive sectors are holding up, the market may be rotating instead of collapsing. Third, stop asking only, is this stock down? Ask, why is it down and is the weakness spreading? That one question can save you from a lot of bad decisions. Here's the simple checklist. Number 1, are only the leaders getting hit or is everything breaking? Number 2, are defensive sectors catching money or are they failing too? Number 3, is the equal weight market holding better than the cap weighted market? Number 4, is volatility rising calmly or is it exploding? Number 5, are key levels holding or are they failing and not reclaiming? That checklist is more useful than guessing. The market does not owe you a clean answer in real time. Your job is to avoid being forced into a decision before the evidence is clear. So the bottom line is this: the market was damaged but not broken. The AI trade was being tested. Semiconductors were under pressure. Defensives were catching a bid. Small caps and equal weight stocks were more resilient than the Nasdaq headline suggested. That is not a green light to chase. It is also not automatic proof of a crash. It is a warning to slow down, watch the spread of weakness, and let the tape prove whether this is rotation or a broader breakdown. Beginner investing survival rule. Do not buy the hottest story just because it finally pulled back. Wait for evidence, respect levels, watch breadth, and never confuse a popular trade getting punished with the entire market falling apart. That is how you survive long enough to actually learn the game.